Good morning, everyone. I hope you're well and that you can all hear and see the screen that I am sharing. Welcome to Autumn Budget webinar. If anyone can't hear or see, can you just drop in the chat so that we make sure that the tech is working as these things should be working. I'm going to try and stick to the hours session. I'm not covering all the changes in the budget that have been announced today. I'm just going to cover the key ones that I feel impact our client base and the people that we on both a business and a personal level. So I'm just going to start just by a brief introduction about me. I'm Carrie Stokes. I'm the director and owner of Spotlight Accounting Limited. So as a business owner, obviously we've been impacted by the changes that were delivered on the 30th of October as well. And the usual disclaimer when it comes to webinars that it's intended for educational purposes, it's of a general nature, it's not legal, specific legal or professional advice, and if you want to take legal or professional advice, or we recommend you do before making any changes. Emma who's our client manager, is also on the call monitoring the chat and any questions that come up. She's next to me in the office so she can shout as and when they come in. So just how I've written this webinar to try and help you get the most value out of it is I'm going to run through what's changed, and these are the key changes. I'm then going to put a worked example through for you all and then come up with a few planning points or actions to come through as a result of these changes. And then at the end of each section, if you can put any questions in the chat box, I will then speak to if there's or cover any questions that we need to cover. So I'm just going to, this is by no means a political webinar. I just want to go back to what was originally in Labour's manifesto. So they pledged not to increase basic hire of additional rates of tax, not to increase national insurance contributions, not to increase VAT except for private school fees, and to cap the main rate of corporation tax at 25%, not to increase the taxes on working people. Now, my personal opinion of this is they almost put themselves in a check position if you were playing chess, because the main areas of taxation they couldn't really attack. And at no point had they put a definition of the real working people. So before the budget, there was a lot of speculation because really the only real taxes they hadn't hit are inheritance tax and capital gains tax. So the quickest and easiest one to box off is self-employed people and how the budget has impacted them. So there are no significant changes to tax and national insurance for those that are running as a self-employed, that's a partnership or a sole trader through personal taxation. There is, however, a big tax change coming in April 2026. So and this is for your combined rental and sole trade income, where that is over £50,000, Making Tax Digital is finally coming in April 2026. And basically what that means is these people are going to have to report quarterly to HMRC. Labour are aiming to bring that down to £20,000 by the end of Parliament. So obviously a lot of landlords that have properties personally, but in particular, looking how rents have increased over the couple of years, they will be pulled into Making Tax Digital by the end of this Labour Parliament. There's also the impact of stealth tax, which I will discuss in a later slide. So I'm going to call out the big one first, which is the increase in employers' national insurance. So the changes that were announced were that employers' national insurance are increasing from 13.8% to 15% from the 5th of April 2025. And the biggest impact on our clients is that the threshold at which you pay national insurance as an employer is reduced from £9,100 to £5,000. However, to compensate for this, Labour will increase from April 2025 the employment allowance to £10,500. They've also removed the £100,000 threshold for the employment allowance. So at the moment, if your employer's national insurance contributions are over £100,000, you don't get the £5,000 reduction. Now, the changes on this is going to have a massive impact on the service sector because those labour-intense businesses, there are just huge increases to the employer's national insurance bill. So what's the additional cost in pounds and pence? Well, when you pay an employee, the first £5,000, there's no employer's national insurance. Where an employee earns between £5,000 and £9,100, from next year it's going to be an extra £615 per employee, or 15% if they fall between the two categories. And over 9,100, instead of paying 13.8%, you're going to be paying 15%. So just putting it into a worked example to quantify this, using the average West Midlands wage of £30,065. If you've got 2 employees, you're £786 better off. If you've got 3, you're £2,900 better off. And then from 10 onwards, this is where it starts to really impact. So those employers that have got 100 employees earning the average West Midlands wage of £30,065, the additional cost of this is £76,158. So this is going to have a massive impact on some businesses. Using worked examples of actual clients of ours, where typically you've got a 2-director company with an average wage of £12,570, which is the basic rate tax band. There's no change to the employer's national insurance costs. Where you've got 5 employees with an average of £23,515, you're actually £1,300 a year better off. But at the other end of the scale, we've got one client with 64 employees with an average wage of £23,264, and that's the actual impact on this is £52,082. So for some clients, this is almost wiping most of their profits out in the year. And then we've got a client with 75 employees with an average wage of £14,979 and the additional national insurance costs of £46,625. Where we do your payroll, the team are over the next month going to work through what the hit on the national insurance is going to be to you, because obviously when you're looking at 6 months, well, no, it's less than that, 4 months notice of an extra £52,000 cost per year, you've got to take action to try and see how you can navigate through that. It's almost like a double-edged whammy, because the national minimum wage is going up. Now, it doesn't look a lot when you're quoting £12 an hour, £10 an hour, £7.55 an hour. But when you work through crunch the numbers, the cost of the gross salary of an 18 to 20-year-old is going to go up by £2,730 a year. If you're under 18, it's £2,242. And if you're over 21, it's going to be an extra £1,500 a year. However, as an employer, you've got to add on the cost of pensions and national insurance. You are legally obliged under automatic enrolment to have a 3% pension contribution, and you've got the increases in the employer's national insurance. Now, the biggest hit, as you can see from this table, is if an employer's got an 18 to 20-year-old working for them. In this current tax year, the cost to the employer is £18,144. Next year it's going to be an extra £3,928, which is a 22% increase. So all these figures can be quite daunting or have quite a significant impact on a small business. So what can you do from a planning point of view? Now, as an accountant, we would always say update your forecast and look at your pricing. So actually, the first thing you need to do is quantify how this change is going to impact you and what it is going to cost your business. And then, some of these changes, you're not going to be able to suffer. It is going to be make or break for a lot of people. Some people are better off, but understand what the impact is on your business. Run through your forecast. Now, that doesn't have to be an all singing, dancing cash flow forecast. It's just looking at what your overheads are and what you need to sell, or what your price point needs to be able to cover these increased costs. I think salary sacrifice arrangements will be more popular. So, for example, where your employee has to make a 5% pension contribution, what they can do is they can sacrifice that pension contribution say it's a £2,000 contribution a year. They can sacrifice £2,000 of their salary in exchange for an employer's pension contribution. The benefit of this is the employee saves 13% on the pension contribution. As an employer, you save 15% national insurance on that amount. I do think there will be a trend towards self-employed labour or offshoring, some basic admin tasks. I think, if you're looking to recruit, is it something that can be done part-time? Can you use a virtual assistant? Is there a self-employed equivalent? The other thing is, and is going to be a key driver, is operational efficiency. I always use the example of a pizza shop we've got locally. He has where he puts in this app how many pizzas he can make each month, each day, sorry. You select your time slot and you order and pay on the app. So from his point of view, his staff costs are half because he doesn't need someone in the shop taking the money, working out the orders. All that comes out to him is a report on which pizza he's got to make each 15 minutes and who's coming to collect them. And it's things like these as an employer that people be really looking to drill down on to save on the staff costs. The other thing just to point out as well, as a director, everybody's got a £500 dividend allowance. So again, if you've got family members that you could give a minority share to, instead of paying them salary, you'd have to pay them some sort of salary, but there is the opportunity to utilise that. So sole director companies don't qualify for an employment allowance. So all of a sudden, at the moment, they're paying themselves £9,100 a year, and there's no employer's national insurance on that. From the 5th of April, there will be 15% on the band between £5,000 and £9,100. So at the moment, pretty typically, we look for directors to take remuneration out up to the 40% tax bracket. So you'd be paying yourself a salary of £9,100, a dividend of £41,170, which comes to the basic rate drawings of £50,270. So what I've done here is modelled keeping the salary at £9,100 and keeping the salary at £12,570. And as you can see, the dividends have reduced for the difference in the salary. So from a tax perspective, at the moment, paying yourself a salary of £9,100 and a dividend of £41,170. That gives you a personal tax bill of £3,558. I've used an effective rate of corporation tax of 22% because we're in this marginal relief realms at the moment of 2002. So the net tax impact this year is £1,556.63. 25-26, if you run those figures, you've obviously got the extra £615 employer's national insurance. So your net tax goes from 1,556 to 2,171. So if we then in 25-26 took your salary up to the basic rate tax band, your personal tax would be less because your dividends would be reduced, would be 3,255. The employer's national insurance the company pays will be £1,135.50, and the corporation tax saving at 22% would be £2,765.40. So the net tax impact of that is £1,625. So actually, as a sole director, if you've got no other income than your salary and dividend, because obviously different incomes would impact these figures, and you're paying tax at an effective rate of 22%, it's actually better to increase your salary to the 12,570 than keep it at the 9,100. So from a sole directors, what are the planning points? The first thing is we've got a lot of clients that maybe have family members that do invoicing that aren't run through a payroll at the moment. Well, one option could be to pay family members through the payroll for admin, which would mean you would qualify for the employment allowance. The second thing is understand where your rate of corporation tax is, because it can range anything from 19 to 25% depending on the profits that the business is making. The impact of other income, so for example, if you've got pension income that takes you up to the basic rate tax band, now might be the time to not run a payroll through a business and just take dividend. Where we run sole director payrolls with clients is we will look at a personal remuneration calculation, because it is going to get to the point where there's not one size fits all with the payroll and remuneration for these for businesses that only have the one director. Just a few additional points from an employment perspective. There's a mandatory payrolling of benefits in kind from April 2025. So at the moment, if you've got a company car, you tend to get your P11D at the end of the tax year. From April 2025, that has to go monthly through the payroll. Theory of that is that your tax will be correct throughout the year. Not quite sure whether you've looked at the Employment Rights Bill or not, but one of the key proposed changes is that employees get statutory sick pay entitlement from day one. At the moment, there's 4 days where you don't have to pay them. And there's also employment rights have increased. They've got full working rights from day one. So again, we're not an HR expert, but what it is, it's just highlighting these points if you do have staff, to make sure that you've spoken to someone to get yourself up to date on the changes to employment. I just wanted to do a final bit about stealth taxes and just understanding the impact of this. Now, in the Chancellor's speech, she kindly told us that she was going to start increasing allowances in line with inflation from 2028. Now, just by a bit of a background with this, 21-22 was the last time the allowances and the thresholds at which certain tax rates apply increased. So what I've done here is I've taken the state pension in 21-22 and the allowances that were in place at that time and increased them in accordance with how the state pension has increased. So in 25-26, the state pension is 230.25. Now, if you take the 12,500 personal allowance in 21-22 and apply that increase, the personal allowance should actually be 16,025 that you earn before you start paying tax. And the higher rate thresholds, the next 37,500, you pay tax at basic rate. That should actually be 48,076. So in 21-22, your basic rate earnings were £50,000. Using the increase in the state pension, in 25-26 from April, that should be 64,100, but it's actually 50,270. So what is the impact of these on taxpayers? So if you have, so what I've done here is if you've got someone earning a salary at £25,000, they're actually paying an extra £691.04 in tax because of the frozen thresholds. If they're earning £60,000, it's £2,637.04. And if you're earning £75,000 or £100,000, it's £3,457 a year. So actually, by freezing the thresholds, these probably have more of an impact on individuals as the main, what Labour would define as working people individuals each year. So just wanted to highlight that. And for self-employed people as well. Okay, there's been no changes to your tax, but actually the Chancellor hasn't increased your thresholds. So you're probably earning more because of inflation, but actually the rate of tax you pay is a lot higher. Are there any questions come through? No? Okay. So I'm now going to roll on to capital gains tax. There have been an increase to the main rates. Quite surprisingly, residential property has stayed at the same rate. You know, landlords have been attacked quite aggressively in the past few budgets, so I was really surprised that residential capital gains rates have stayed the same. The lifetime limit for business asset disposal relief remains at 1 million. Business asset disposal relief is an allowance that you get of paying a lower rate of capital gains tax when you sell a business or shares in a business and you meet certain criteria. So before the budget, the main rate of capital gains tax was 10%, the higher rate was 20%, and you paid 10% capital gains on businesses that qualified for business asset disposal relief. The main and the higher rate immediately went in line with the rates for residential property, which is 18% if the gain falls within your basic rate tax band, which is below 50,270, and 24% if it is in the higher rate tax band. Business asset disposal relief is increasing over the next 2 tax years. It's going up from 14% to 14%, then to 18%. So from 26-27, if you dispose of your business, the business asset disposal relief, all it is doing is extending your basic rate capital gains tax. So just going through some worked examples of the impact of this. If you've got a business that's worth £1 million and you sold it in the current tax year, you'd be paying £100,000. From 26-27, you'll be paying £180,000. If your business is worth £5 million, it will go from £900,000 to £1.14 million. So the larger the business, the bigger the impact on these figures. One of the things that I think will become more popular as a result of this is employee ownership trusts. Now, without going into too much technical detail, an employee ownership trust is a vehicle where a trading business can sell to its employees free of capital gains tax. There's a lot of criteria to be able to meet this, and in the budget they tightened it up. Part of this tightening up of the criteria for this is that former owners can't retain control. The trust has got to be UK resident, and there's a four-year clawback with regards to the capital gains tax. There's a 4-year window in which they can say this didn't qualify as a capital gains free disposal. There's also more of a need for a valuation expert because you need to be able to demonstrate that the employee ownership trust didn't pay more than market value. I'm not going to go into any more detail than that here. It's just being aware of that vehicle and make it part of a potential exit strategy. So what are the planning points from a capital gains tax point of view? Timing of disposals. Now, you might not necessarily like the rates of capital gains tax, but it's one tax that you can almost control when it triggers. Exit planning is more important. Because you've got the timing of disposals, getting it right and getting a plan in place to exit the business will become more important. Making sure you use your lifetime allowance for business asset disposal relief and looking at your business structure. Now, in some circumstances, it might be more beneficial as part of an exit strategy that you create a holding company because there's something called significant shareholding exemption. So there's no tax on that sale. So again, part of these increases just makes the whole planning of the sale of the business or sale of any assets more important, and understanding the additional tax burden as a result of this. I do generally think employee ownership trusts will be more popular. You look at that example with a £5 million business. If it's sold to its employees, it's going to save them £1.14 million in tax. Furnished holiday lets. Yeah.
On that, Mark Dobbs has asked a director that is 1 year into a 7-year EOT. If the EOT is currently underway, do any of these changes apply?
Mark, I'll have to come back to you on the question. So Mark's question is, if a director's 1 year into an employee ownership trust, do these new rules come into place? I'll come back to you on that one because it's one of those things that the full detail isn't out yet. And I would guess if he's 1 year in, the 1 year window will end by the end of this tax year anyway. So I will just check and come back to you whether it gets backdated. Furnished holiday lets. Now, there has been a popularity in Airbnb and furnished holiday lets. And this isn't a new announcement, but it was in the previous budget that this is going to be abolished from April 2025. Now, furnished holiday lets had preferential treatment in respect that loan interest was deducted as a cost from the let income. And it also had capital allowances. So if you renovated a furnished holiday let, you could get a deduction on the plant and machinery and the equipment going into that furnished holiday let. From April 2025, that is stopping. And they're no longer eligible for business asset disposal relief. So furnished holiday lets from April 2025, in effect, will be taxed exactly the same way as normal AST lets. Inheritance tax. The current thresholds remain until 2030. Again, you've got the impact of stealth tax on this, because obviously if they'd been in line with inflation, these thresholds would be a lot higher. Standard nil rate band is at 325,000 and the residence nil rate band is at £175,000, and there's tapering after £2 million. Now, typically, you know, the average household in the UK is £275,000. It doesn't leave a lot of room for manoeuvre for an unmarried person with an estate. There are no changes to gifts. The biggest impact, I think, on number of people in the UK is the bringing unused pension funds and death benefits into the estate from the 6th of April 2027. There's a technical consultation due on the detail. The initial draft in one of the examples refers to a spousal exemption, but the technical detail doesn't specify that spousal exemption. So it looks like where a husband leaves his pension pot to his wife, that will be tax-free. However, how that works, it isn't in the detail yet. And one big question has been who pays the tax. So, for example, if you've got a pension pot and you pass it to your children, for the children to take money out of the pension scheme, they'd have to pay tax to then pay the tax. Well, actually, in the technical consultation, the initial detail, it refers to the pension scheme will actually be paying the tax, so there won't be, it doesn't look like there'll be that double taxation. I can't guarantee it because obviously this is all draft legislation. The biggest one is the changes to reliefs. Agricultural property relief and business property relief, you get 100% on the first £1 million and 50% after that. So prior to these changes, where you had a trading business and if you left it to your children, there would be no tax payable on it, because unless it was a property or an investment company, you'd get full business property relief. So we've obviously got a lot of clients that have been working on a succession plan to hand down to the next generation, and all of a sudden these farms and these businesses fall within the inheritance tax estate. The other point that they have said is you can pay IHT over 10 years or until the asset is sold, but because they've changed the rates of interest, HMRC would charge you 8.75% interest on that overdue tax per year. So I've just run, these are sort of like ballpark figures of a few clients that we've got and we've been talking to about their inheritance tax estate. So the first one, where you've got a business value of £2 million, you've got £500,000 in your main residence and £500,000 in your pension fund, with an estate value of £3 million. Now, I'm assuming that the estate is going down a generation, not spouse. Prior to the budget, the inheritance tax was nothing. After the budget, the inheritance tax is going to be £600,000. Where you've got a business value of £1 million, £500,000 main residence, £500,000 in the pension scheme, there's no inheritance tax prior to budget, but there's £200,000 following budget. Now, the final case is a specific client that's got a business value worth £500,000. Their main residence is worth, but it's worth more than that, but I've used £500,000 as the example. They've got £1 million in their pension fund, and that pension fund is tied up in assets, and a buy-to-let property of £300,000. The estate value is £2.3 million. Prior to the budget, their inheritance tax would be £120,000. Post-budget, it'd be £400,000. Now, thinking about this estate in particular, there isn't £400,000 worth of cash to pay this. So again, we're having to re-look at their sort of like investment portfolio and how everything's held, just because, again, the pension fund is property. So again, the idea, they weren't using the pension fund to pass down value. They were using the pension fund because they invest in commercial property, and that's what they do. Obviously, they're going to hit the beneficiaries of their estate are going to hit a huge inheritance tax issue when it gets to that point in time. So a few planning points on how to navigate this. Review existing wills. This is really important. I was on a mastermind group with a group of accountants the past couple of days. And one thing that was mentioned is wording of wills. And, you know, some wills could say, we leave all assets that qualify for business asset disposal relief to my son, and my daughter gets Y. Well, actually, that wording will need rechanging. Also, think about who the beneficiary of the wills are going to be, because obviously now more assets are coming into inheritance tax. It might be worthwhile skipping a generation. If you have a family member that has passed away in the past 2 years, there is the possibility of a deed of variation. So again, if you've inherited assets that qualify for business asset disposal relief or agricultural property relief from your father, you may want to review who actually inherited that asset to avoid a generation's worth of inheritance tax. Consider gifts. So again, we sat with a client last week who had a sum of money to a family member. You know, once you make the gift, the 7-year clock triggers. All of a sudden, when you've got an estate that had no inheritance tax and you move into an estate where there is inheritance tax applying, and you've got the cash, it might be worthwhile giving those gifts earlier and to start the 7-year clock and getting that value of cash out of the estate. Speak to your financial planner. You know, there are policies and are other tools that I am not qualified to talk about that can help you navigate this. It's really important that you understand your estate, understand the potential inheritance tax, and what actions you can make to navigate this. And then back to this sort of loops back around to capital gains tax. It's really important now to think about succession planning, to really think about what you want to do with your business assets, your property portfolio, and how that is either you're going to exit from it or how you're going to pass that on to the next generation. Are there any inheritance tax questions? No. Stamp duty, land tax. There have been increases announced. The higher rate for additional dwellings increased from 3% to 5% from the day after the budget, and where non-natural persons acquire more than a property worth more than £500,000, that increases from 15 to 17%. One thing that wasn't announced in the budget or wasn't made clear was that a temporary uplift in thresholds will expire from the 1st of April 2025. So at the moment, the zero rate of stamp duty will reduce to £125,000. It's currently at £250,000. And the first-time buyers on homes at £625,000, it's currently at £500,000. That gets reduced to £300,000. So let's put that into real figures. And I've split it between landlords and residential because I know I've got both type of clients on this. If you, as a landlord, if you're buying a £250,000 property, pre-budget, that will cost you £7,500. Post-budget, that will cost you £12,500. Post the 1st of April 25, it will cost you £15,000. From a residential point of view, for that £250,000, prior to the 1st of April 25, it will cost you nothing. The stamp duty will be £2,500 from the 1st of April 2025. So if you're looking at planning acquisition of properties for your portfolio, just be aware that there are those additional changes coming in from the 1st of April. Double cab pickup trucks. I've got a real bone of contention with this. Again, it wasn't announced in the budget, but HMRC have done a U-turn on their U-turn. Will they do a U-turn again? I don't know. This is all proposed legislation. It hasn't gone through government. So from the 6th of April, double cab pickup trucks will no longer be treated as a van. They'll be treated as a car for benefit in kind. There are transitional arrangements for trucks that are delivered or ordered before the 6th of April 2025. So we've had a few clients that do generally use these trucks as workhorses that have got their order in now so that they can take advantage of the treatment over the next few years. So where you have a truck currently, or you've got one on order, or will have ordered it before the on or before the 5th of April 2025, it will be treated as a van until the earlier of disposal of that asset. If you've got a lease, the lease expiry, or until the 5th of April 2029. So at the moment, like at Olympic, if you're driving around in a double cab pickup truck, from the 5th of April 2029, it will be classed as a car for benefit in kind purposes. Obviously, car benefit in kind is based on CO2 emissions, so it's going to be quite a big hike in tax on them. Just one point that I had from comments on social media and just from questions, obviously Land Rover Defenders commercials only have one line of seats. So because they haven't got that second line of seats, they still qualify as a commercial vehicle as the proposed legislation stands at the moment. Bit of a reminder with regards to corporation tax. The main rate of corporation tax where profits are over £250,000 is 25%. The small profit rate below £50,000 is 19%. And the marginal rate is staying the same. So where your profits are between £50,000 and £250,000, that element of your profits is 26.5%. So basically where you're earning, your company makes taxable profits between 50,000 and 250, the nearer to the 250, the nearer it is to the 25% overall rate of tax. Capital allowances. The first year allowance and expensing remains. There's 100% annual investment allowance where you're buying plant and machinery of up to £1 million. And the zero emission cars, the 100% first year allowance remains. One thing that often gets missed with the annual investment allowance and capital allowances is if you buy a building or a commercial building, there is a method in which you can claim capital allowances on the integral fixtures and fittings. So if you buy, for an example, if you buy a building, it is worth having a fixtures and fittings review because where there's boilers, fire alarms and things like that, there is the potential to make capital allowances on that. So just to bear that in mind. Research and development, again, it's been quite popular in the press with the changes that have been announced and the clampdown on it. Just as a reminder, if your business makes a scientific or technological advance, so if it has something and it improves it, there is a potential, a more beneficial tax rate on the expenditure in achieving that scientific or technological advance. You don't have to achieve it, you can try to achieve it. There's one scheme from April 2024, and one welcome bit of news for me is that there is a consultation on advance clearance. At the moment, if you make a scientific or technological advance, what happens is you have to pay us to do a quite complicated report and tax claim, and then you hand it to HMRC. Keep your fingers crossed you don't get an inspection. If you do get an inspection, you get someone that knows what they're talking about. Otherwise, it can be quite a painful process going through the inspection, whereas with advanced clearances, a reduced report, you know you can make the claim and there's no comeback on it. I'm just going to round up with the other measures that have been announced. It's everywhere in the press. The only VAT change is the VAT on private school fees. And the biggest one that I think has gone unnoticed is the cost of borrowing from HMRC. It will now be base rate plus 4%. So at the moment you're paying 8.75%. So where sometimes when cash has been a bit tight, it's been easy not to pay your PAYE bill because it's often cheaper than borrowing from the bank. It's not something that we recommend as a permanent overdraft facility, but running a business, it's difficult and you have cash flow issues. Obviously, the cost of not paying your tax is going to be significantly higher moving forward. The other thing to remember as well is, even from a personal tax point of view, on a time to pay arrangement is not tax free. So again, if you get to January and you can't pay your personal tax bill, or you get to the point that you can't pay your corporation tax bill, the rate on that agreement is going to be 8.75% moving forward. So I've tried to keep it as short and as brief as possible without overloading on information, but hopefully you've got a few key actions that you can take from this to help plan moving forward, be it exit planning for your business, be it looking at what the employer's national insurance increase is, be even looking at your estate from an inheritance tax point of view, and just seeing what changes can be made over a period of time to navigate this. And then finally, are there any more questions from what I have covered? No. So I just want to round up by thank you for sparing your time to listen to me for 3/4 of an hour. I hope I've tried to put it into monetary terms, and I hope that it's given you a few key action points and a few things to think about. If you're a client of ours, we are producing those calculations for payroll. Just bear with us. If you are a director only payroll, it will be after tax returns that we do that, because the main sort of concern for us at the moment, without causing an offence, is those clients that have had these massive NIC hikes from April next year and helping them move forward. If you want to book a call with me and you're a client, you know where I am, just to chat through any concerns you've got and to help navigate these increases. And it's not just me, Emma, Kaylee and the team are all here to help and support through this, because I think with some businesses it's been a massive blow. I'm going to wrap up there, and hope you enjoy the rest of your day. And once again, thank you ever so much for listening to me for 3/4 of an hour. Thank you.